my name is Stavros Tousios. I'm the Forex market specialist at FXPRIMUS, and this is our 2017 to 2018 end of year major currencies and commodities outlook. In this video, I will give you a summary of what happened in 2017 and why major pairs have performed the way they did. And based on the presented cases, I'll provide my own views for 2018. Please note that Forex trading and trading in other leveraged products involves a significant level of risk as is not suitable for all investors. Trading financial instruments may result in losses as well as profits, and your losses can be greater than your initial invested capital. Before undertaking any such transactions, you should ensure that you fully understand the risks involved and seek independent advice if necessary. Any opinions, news, research, analysis, prices, or other information contained on this video or linked to from this video are provided as general market commentary and do not constitute investment advice. FXPRIMUS or its representatives do not accept liability for any loss or damage, including without limitation to any loss of profit, which may arise directly or indirectly from use of or reliance on such information. In this first slide, one can see how the 7 major pairs performed against one another. From the chart, it is apparent that euro against dollar was the #1 performer, getting 12.37% year on year, with the British pound coming on the second place with a gain of 8.35%, following with Aussie, Kiwi, dollar franc, dollar yen, and dollar CAD. Now, let's look at those a little closer. The US dollar struggled to perform on the offensive for most of 2017 amid growing political, geopolitical, and environmental related risks, with the real trade-weighted dollar index moving 6.16% lower year to date. Trading was characterized by broad bearishness surrounded by Trump's policy, which prompted investors to shift to better opportunities until uncertainty subsided. Opportunities for short-term investors, though, were indeed decent. They switched the US 10 to 15-year effective yields and the US dollar index to a reverse course up until early September and October, respectively, mainly due to delays around fiscal policy. Since then, and up to year's end, both have remained somehow on a trading range. After a period of not so good 9 months, expectations for rate hikes and considerable fiscal stimulus strengthened the US economy. Real GDP grew at 3.3%, a 3-year high. Core inflation remained moderate at around 1.7%, and unemployment remained at 2001 lows. Keeping in mind a risk appetite that reflects Fed's hiking cycle and a substantial policy boost, along with Powell's Yellen-like accommodative stance of gradual normalization, I believe 2018 will push the dollar index lower to 82.85 levels. This is where the 61.80 Fibonacci extension betides, and in case prices push lower, then I believe the 72.30 Fibonacci retracement could be reached. But I see no extension below that level, as such a move could take the index towards a very low price for the index at 80. Over in Europe, while most banks expected euro to range on both risks of steepening rates and politics, anticipating a low of 1.05 versus dollar, euro saw a tremendous approximately 12% gain, mainly driven by ECB's announcement to taper its quantitative easing program, as well as owed to a weaker US and GBP counterpart as seen on the chart. With ECB's particularly accommodative monetary policy stance continue to improve sentiment indicators, Q3 real GDP growth confirmed at 0.6%, driven by robust domestic demand, an expansionary private sector, and favorable bank lending conditions. Expectations for future interest rates supported the economic recovery in the euro area. Under this base case, ECB's decision to recalibrate the asset purchase program from 6 to 30 billion euros a month from January 2018, with an extension of the period the stimulus runs, is likely to stoke inflation and boost the economy. Despite the tapering came at the period where euro was not appreciating, making the announcement quite dovish, I believe that the slow pace in policy normalization will support inflation into 2019, but not considerably in 2018. On the above basis thereof, and with low rates to remain the case in 2018, I forecast the euro dollar will extend to 1.279 to 1.311, breaking above the descending trend line started in April 2008. Although some resistance is likely to be seen around the 1.21, 1.22 level, I think the second extension from the week starting November 5th, 2017 will be reached, and that is the 1.28 level. Now, in Europe again, Great Britain, despite the first quarter of 2017 found cable vulnerable following a period of significantly low liquidity and exposure to flash crashes, triggering Article 50 shifted investor sentiment. This was also attributed to global growth and the optimistic outlook of the euro area. On the contrary, sterling did remain markedly below pre-Brexit levels for all 2017 and below the pre-flash crash level for nearly half of 2017. While pound dollar seemed to be and still seems to be a victim of political rage, short positioning has failed to extend the pair stringently lower, which added value to the currency's medium-term worth, as seen on the chart. Yet, inflation rose to a 6-year high rate of 3.10%. This leaves the British pound far away from the annual inflation rate target of 2% set by the government in order to maintain price stability. In addition, the flattish wage growth combined with very soft retail sales challenge investor confidence as consumer demand and growth are likely to remain under pressure. Apart from balance sheet susceptibility and an exit bill price tag, pound volatility will be driven massively by Brexit trade negotiations and whether a soft or hard Brexit is achieved between UK and the EU. Keeping in mind the consequences of Brexit, divergent interests in the UK Parliament, a rate hike after long 10 years and the possibility for early elections, my view should be bearish. In the hope of formulating a deal and a probable lightweight hiking cycle, I'm expecting pound dollar to remain above 1.27 for all of 2018 and possibly head towards 1.39, where the first Fibonacci extension begins, and possibly even higher at 1.41 as a strong resistance level lies there. Moreover, I do want to mention that I do expect weaker macro fundamentals. Going to Japan, with Abe winning the 2017 Japanese snap general elections, there is little to no room for changing Bank of Japan's monetary policy stance. Thus, inflationary pressures are likely to remain below the 2% year-on-year target. Hence, markets are probably going to be driven, as they did in 2017, purely on external factors, in essence, risk sentiment. Acknowledging increasing vulnerability amid geopolitical concerns, the effect on short-term and long-term yield spreads, and the firm global growth, I believe that speculative rallies will move dollar-yen sideways between 108 and 118, with the price ending 2018 closer to the higher end of the range, as I do see the triangle pattern formed breaking on the upside and expect a double top near 118. On this section, we are seeing how the commodity pairs have performed against one another. It is clear that since July 2017, oil price started reversing with a correction in September 2017. After that, and from October onwards, oil has seen an upsurge and took over even the dollar CAD pair in terms of gains back in October, starting 2018 on a very positive footing, something that is already very evident. On the other commodity pairs, Aussie came at a third place, Kiwi at a fourth place. Let's see how this happens on the commodity pairs first, and then we will see the oil itself as well. Let us start with the Canadian dollar. Following a prosperous 2017, Bank of Canada is likely to maintain its hawkish rate shift in 2018 as fundamental-based criteria support. Despite the fact that raising exchange rates and wages drove investor sentiment in 2017, in 2018, downside risks due to NAFTA negotiations and fiscal policy effects, whether by the US or Canada, may be in play. Furthermore, considering the effects on the increase in US shale production, CAD could be worse supported by oil. On the contrary, OPEC's extension of the production cut to 2080 and beyond, an extension that has benefited the Canadian dollar in 2017, could offer some support. Given the above information, I believe Loonie will continue its bullish rally into 2018 against the US counterpart, although in much weaker scale than 2017. I expect that dollar CAD will not hike above the 135 level and that it will fall towards 1.192 level by year end, creating a double bottom. Aussie. For most of 2017, Aussie improved gradually on RBA's accommodative monetary policy, with headline inflation easing to 1.8% year-on-year. I expect RBA to maintain the same path to policy normalization, at least for the first half of 2018, while I also expect some inflationary pressure for the same period in the wake of solid wage growth. This being said, Aussie dollar is likely to experience some slight downward pressure during the first and maybe second quarter of 2018, but nothing that could move price below 0.7360. Despite iron ore prices in China are pricing and the Chinese economies at some various buyers, vulnerability is likely to subdue by year's end amid the probable RBA hiking cycle starting between end of quarter 2, beginning of quarter 3 of 2018. My view following this is that a long-term rally with first stop near 0.84 is quite feasible. First resistance to be seen would be near 0.8160. Amongst the commodity currencies, Kiwi also performed well for most of 2017, taking advantage of oil prices. However, with RBNZ Governor Wheeler stepping down and the raise of the National Party in quarter 3, New Zealand dollar weakened near January 2017 lows. In addition, oil's effect on Kiwi were not as great as on Aussie or Lumi. At the same time, it's worth mentioning that New Zealand saw a building boom, which adds to the increase in labour supply and lifting lower wages up, as well as that New Zealand is top output performer between G10 countries. Taking into account weighing yields surrounding carry trades and peaked inflation expectations, I believe that prices will move higher towards 0.7560 and possibly higher to the top of the channel. This, of course, assumes RBNZ raises interest rates in quarter 1, quarter 2 of 2018. Our favorite oil. Now, the first half of 2017 found WTI prices plummeting below $40 per barrel amid oil oversupply and rising US shale production. For the second half of the year, demand for oil increased due to an acceleration of consecutive inventory declines, as seen on the chart, taking price to a 30-month high. In fact, tightening supply came as a result of OPEC's recent decision to extend output cuts. With the possibility to experience a supply restriction throughout all 2018, I expect a strong demand growth as the recent extension till May 2018 has traders responding already. I see volatility easing off, yet I expect price swings to be a victim of supply versus demand battle, while the market goes through fundamental changes. This being said, I foresee oil prices hitting a high of $68 per barrel, the second extension as seen on the slide, while my prediction for the lower end stands at $51, $52 per barrel, a possible retest of the support. I expect WTI to close 2018 above $57 per barrel and range bound with an average of $62 per barrel. Our precious metal, gold. Gold held on to 2017 gains following a bullish rally since January 1st, while dollar had depreciated owing to significant deterioration in the political and economic situation in the US. Gold appreciated nearly $85 per ounce in quarter 1 and a total of 10% until the end of quarter 2. The rally can be seen in this slide. Expectations that Fed would hike rates gradually, not aggressively, along with heightened geopolitical risks in the Middle East and North Korea, and the uncertainties surrounding US fiscal policy, tilted gold even higher by end of quarter 3. Over the last quarter, sentiment shifted as the stock markets became very bullish. According to gold's chart, and given the recent high and lower US long and short-term bond yields in quarter 4 2017, I expect gold price to experience a moderate mid-year upside move towards 1400-1450, the strong resistance and the 100% Fibonacci extension. And then I expect a reversal towards the low of $12.45 per ounce, where the bottom of the channel betides by end 2018. Thank you for watching our yearly outlook. For any questions, feel free to email me at stavros.tousios@fxprimus.com. Have a successful year ahead.